Hello and welcome to the last update for 2022. My name is Shahrukh Mutali. I'm a financial advisor at Saturn Advice. I'll leave it up to you to read through this disclaimer. Please pause the video and have a look. I've been talking about inflation and I'll continue to talk about inflation because that seems to be driving everything even right now. So inflation has been subsiding and the trend is continuing. I have suggested previously in my previous updates that I expected inflation to drop progressively month after month. And we're talking about the US inflation here. And I've shown the US headline inflation on the left. On the bottom right, you've got the UK inflation. We'll talk about it in just a little bit. So the latest figures come out at 7.1% year on year. That's the US headline inflation. And that was again below the target, below the expectation. Now, I do believe that this will continue. The trend will continue, and we will see inflation come down, if not to the target, at least close to a target somewhere mid of next year. And that is when I expect the US economy to have at least a mild recession, or if not a moderate one. But in UK, last month I had touched upon that they saw a 41-year high in inflation last month, and that also inflation has come down a little bit. An interesting point that I want to note here is that the inflation there is driven. There's a far more influence from the energy side of inflation for the UK and the European region in general because of their reliance on energy rather than the US. And hence, we might see their inflation drop down at a faster rate as we progress into next year and the warmer months come through, because right now we have peak winter and the energy consumption is quite up there. So it could be that while they are lagging the US inflation quite a bit right now, they may catch up as we see the temperatures rise over the next year. Now, coming back to the US, core inflation, which is more representative of the long-term trend, is also declining, which is very heartening. It has happened before in this year, but I believe that this time around, it is the impact from the rising interest rates, the monetary policy that was made restrictive round about the March region that is beginning to have an impact with a lag. As I have explained, there's a lag in its impact. The services inflation, which is proving stubborn, and it is continuing to do so. It seems to have peaked, but it is still sticking at the same level, and that could be potentially leading into the holiday season. People are spending a lot more on services than they would otherwise. So we could be in for another similar sort of level for the next month. But I do believe that interest rates will eventually bite into this inflation, and we will see inflation across different indicators come down. So what's happening with the interest rates? I've shown the US federal funds rate on the top left and the New Zealand OCR on the bottom right. And you can see they've been rising in a similar fashion, albeit I'll point out that the US Federal Reserve has recently, in the last their meeting, the last announcement, they have dropped the rate at which they were increasing. They were hiking the rate down to 0.5%, while the New Zealand RBNZ has actually accelerated in their interest rate hikes. The last one was 0.75%. Previously, they were doing 0.5s. And that could be a reflection on RBNZ's belief that New Zealand might be in for a tougher battle with inflation for some indigenous problems. I have talked about this previously, that New Zealand has seen, impact from border closure, a prolonged border closure compared to the rest of the world, and that has resulted in a labor shortage, and that is fueling wage inflation, and wage inflation is quite structural for overall inflation. So I think New Zealand economy could be in for a rougher ride compared to the US economy going forward. What that means to the share markets? Well, the US share market has been moving sideways, and you can see, since about mid of the year, it hit a bottom, hit a peak around about early August, again, September, October down. And then this rally, I had previously forecast that I expected there to be a strong finish to the year, and that really was looking like it would fulfill my forecast. But then the Federal Reserve came and punched the air out of that really, and it sort of has fizzled away over the last few days. And now the Federal Reserve came out, and it was very factual. Inflation is still way higher. It is coming down, but it is still way higher than the target. So they're right on that one, and they have said that they will stick on the restrictive monetary stance until inflation structurally comes down to target. Now, I do read it along the lines that they want people to believe that inflation isn't in the rearview mirror yet. The impact of their monetary policy will start to progressively show, will continue to progressively show in inflation numbers, but they don't want the general public to believe so, because if you believe that inflation is not a problem going forward, then you will be relaxed and you will go about spending the way you would normally, and that is not going to help inflation. So it will be counterintuitive to what the Fed is trying to achieve, and that's why they have to come out and sound very hawkish, is what the financial term is, but essentially very stiff in their stance. Earnings are going to be pretty critical coming over coming months, because some of the impact of the drop in earnings leading up to the recession has been priced in. But really, if the real drop in earnings is worse than what the expectation is, then it could result in share markets falling a bit further. But yeah, more volatility to come. But essentially, what I want you to focus on is this graph that I have shown previously, that is markets always bounce back. And this is a lifespan of investment, about 80 years, and it's the same cycle every time. The markets may fall for a year, sometimes longer. So there could be, we've been falling, we've been in this bear market for about a year, and we could be in it for another 6 weeks, could be in it for another 6 months. I don't know, and nobody does, I think, but eventually they will bounce. So what I want you to take away from this is, now is a good time that the market is down. It may fall down a bit further, but you can never capture the bottom accurately. So if you're sitting with a pile of cash, well, you don't want to be sitting on the sidelines when the markets turn, because when they turn, they will rebound quite strongly initially, at least, and then they will continue on for a few years. But you don't want to be sitting on the sidelines with a pile of cash at that time. So yeah, form a portfolio using these points that I have listed there. I have talked about this in my previous video, so not going to go into the details. But if you think that you may struggle to do so yourself, please reach out to us. We are there to help. We specialize in formulating portfolios customized to client needs, to their goals and objectives. Here are the details for the business as well as myself. If you want me to talk about a specific topic going forward, please do reach out to me. But most importantly, spend some quality time with your family, friends, and loved ones. Have a lovely Christmas, everyone. I'll see you in the next video. Bye.